What's up, everyone? It's Caddy with MoneyVest. So markets here pushing higher. NASDAQ almost now recovering back to all-time highs, trading at just under 16,350. The S&P 500 just under 5,200, pushing up another 1% on the day. And both of these indices are now back in a very nice consistent uptrend of higher highs and higher lows, and almost are now trading back up to those all-time highs once again, as the volatility is of course lower back in the 13s. So hope you all enjoyed this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. I would really appreciate that. And of course, links to our Discord and Patreon is going to be down below if you're interested in joining us, and of course getting access to all the members only private videos, including 50 plus lectures and tutorials, including our entire 30 stock shopping list, as well as our MoneyVest index, which has yielded some very good returns and results here, and also all the trade alerts and trade ideas, as well as options alerts. And also we do have a sale for all individual courses in the month of May. The coupon code is going to be May50. You will have 50% off on all individual courses as well. So link's going to be down below. We'd love to have you on board, and also do connect with me on Instagram. My handle is going to be CASWRP. So this was the state of the market. A very, very nice move to the upside for the NASDAQ here, 1%, S&P 1%, the Dow Jones pushing up about 0.5%. IWM, on the other hand, also moving higher very, very nicely. I was up a little bit over 1.29%. So recovering from those lows of about $190, it has pushed back up to 204. That's about a 7% recovery. And of course, the recent highs sit well over $212 per share for IWM. Now, the U.S. economy is headed for a hard landing. The Fed rate cuts won't be enough to rescue it. This was Citi, and there was another catalyst which basically came out from another analyst saying the market is recovering nicely from April's pain, why it could keep gaining further. So last year's consensus was that the U.S. economy was headed for a recession, but that didn't happen. This year's consensus is that we'll have a soft landing in which the economy slows but won't tip into a recession. That could be wrong too. Doubling down on his contrarian views, Citi chief U.S. economist Andrew Hollenhorst told Bloomberg TV that he sees a hard landing. In fact, inflation and the labor market will weaken enough that the Federal Reserve will cut benchmark rates 4 times this year, far more than the 1 or 2 rate cuts that Wall Street is expecting. And he's warning proved precedent as a labor market payroll report the following day showed that the economy added 175,000 jobs in April, down sharply from the blockbuster increase of 315,000 in March, well below 233,000 gain that the economist had predicted. So this actually is going to end up being a positive catalyst for the market, because if we do see 4 rate cuts this year, that means there's something seriously wrong in the economy that the Federal Reserve is trying to solve, or Jerome Powell is trying to quote unquote fix. And that, again, in the short term, it may mean this. Let me just point it. In the short term, it may mean this. Over the long term, it's going to mean this. And it could also mean, this, where the markets, of course, do sell off in the short term on the back of weakening economic conditions, labor market going, very, very uncertain with the fact that unemployment's going higher, let's say, or jobs being added are not that much. But this right here is where eventually, with the stimulus, with the quantitative easing or the pivot, this is where we could potentially end up in the markets, of course, long term. And that's exactly why I've always mentioned on this channel, and I'll keep saying that again, when the VIX is high, it is time to buy. When the VIX is high, it is quite literally the time to buy, because eventually the VIX comes down and you can already start to see how the markets are responding to that. Because VIX now, you can see it went from highs of 21 down to 37% lower, 13.5. And during that time period, of course, the S&P 500 very clearly went down to 49.53 and is now up 4.5, 4.6%. Hence the case in point here that I've tried to mention over and over and over again. When it comes to buy signals, you don't have to go anywhere, honestly speaking, when it comes to understanding the risk reward and when it's actually the very, very favorable time to be a buyer. I'm telling you, the analysis that we do, again, as a community, I'm not taking all the credit, because we as a community do a really good job in kind of understanding where the risk reward is really good. And we, of course, combine that with the MoneyVest index. Of course, we came down to lows of about 3. Now we're pushing back higher. We're now at 3.66. So again, we're moving back higher as the volatility is coming down. Market breadth is once again getting a little bit more to the upside. We're seeing that, recovery back up at 3.66. The moment it gets up to this sort of red line, so I'm going to mark that out over here at around 4.10 or 4.2. So 4.1 to 4.2. The moment it gets up to that level, of course, we have to be a little bit more careful, more cautious with whether we are comfortable buying at those prices or not. So the way that I look at this, and I'm gonna again be as clear as possible. The way I look at this is that these green lines that you see, right? So the green circles that you see are pure buying opportunities. By every single definition, I could just tell you that over here is buying opportunities for the market. There's absolutely no doubt about it. And every time we see this MoneyVest index coming down to that level, it's a no-brainer buying opportunity for me, right? So I am dollar cost averaging and I'm buying into the market. However, there's a big catch here. Every time the index is up here at 4.1, 4.2, that does not mean that we have to sell, okay? That does not mean that we have to sell. That does not mean that we have to go short. That does not mean that we have to liquidate all of our positions and run for the exits. No, because markets can stay irrational and exuberant and higher for longer than the markets can stay lower for longer. Okay, that's another thing that I've learned over my years of experience in trading is that markets can, of course, stay irrational for longer. Markets can remain overvalued much longer than they can remain undervalued. Okay, so our buying window, always think of it this way, our buying window is much smaller than our selling window. Okay, our buying window is also a lot quicker to recover than our selling window. So to give you an example, just because this index was over here at around 4.07, 4.8 did not mean that it was immediately a selling, signal or we need to get out of the market, because it can stay up there for a very long time. And of course, over here, you can see that it was at 4.2, 4.19. It kind of stayed above that 3.8, 3.9, kind of recovered back up to 4.1. So it stayed up there as the markets continued to rally higher and higher and higher. So really, I use this index as a buy signal only. This is a buy signal index only. That's what it tells you. It tells you the best buying opportunities in the market from a risk reward perspective and when it's exactly the time to start deploying money and cash into the market. And of course, we did buy a little bit here on this dip when the markets were down in the sub 5,000 level. I did pick up Apple. I did pick up, or actually, did I pick up Apple? I picked up Tesla. I picked up SMH, VUG, some of those ETFs, and of course, they're doing really well, right? So that's the whole idea. It's kind of understanding the risk reward, deploying the cash when the time is right. Again, this is not a timing indicator. It's only telling us the risk reward, and of course, the markets can certainly go lower. That's why we have our nibble buy prices, our light buy, our aggressive buy, our heavy buy, our no-brainer buy, and our fair value. So there's a lot of tiers of support and demands that we highlight in our analysis and our videos. So it's helpful that, of course, markets can go lower, so we don't need to go crazy deploying all of our dry powder into the market. So that's something to keep in mind. Now, the market's recovering nicely from April's pain. Why it could go higher? So this was BofA Securities Strategist with Haish basically mentioned that at their core, stocks are, of course, a reflection of future earnings growth, and meaning that despite near-term distractions over the medium and long term, the primacy of growth becomes apparent. And the Magnificent Seven, which fueled so much of the 2023's rally, have done nearly all the hard work in terms of earnings this quarter as well, notching a 48% year-over-year earnings per share growth in the first quarter, compared with an estimated 2% decline for the remaining 493 companies. So, of course, they've done really well, and this is the entire market. Fantastic gains from the entire market here. So NVIDIA pushing up 3.7, Microsoft up a little bit over 1%, Apple did struggle slightly, Google was up, Meta was up 3%, Amazon pushing higher, Tesla was up almost 2%. So pretty much all sectors in the S&P 500 were green. Financials green, consumer cyclicals were green, industrials, auto manufacturers, retailers, utilities, basic materials, energy. Healthcare was a little bit more on the flatter side. Consumer defensive also very, very flat on the day. But of course, all sectors in the S&P, all 11 sectors were green. In the last 1 week, energy is the only sector that is down because of the head and shoulders on crude oil and then the fact that we broke down. In the last 1 month, of course, a little bit of a split market, but most sectors, most important sectors are, of course, up on the month here. Bitcoin crawling back above 63,000, Ether just over $3,000 once again. So this was the crude oil analysis. We had a head and shoulders, left shoulder, head, and a right shoulder. And then we got a little bit of a breakdown. So we'll go ahead and turn this level back into a resistance for crude oil. And the next target and support is going to stay put at $73, $74 a barrel for crude oil. So that's going to be that next level to keep in mind. Bitcoin here pushing right back up. So this right here is the analysis, still very much within the context of a consolidation here. Support level is going to stay put at 62,000 to as much as 59,000. So this right here is going to be an area of support near term for us to keep in mind for Bitcoin, and of course resistance staying put at $72,000. When it comes to Ether, again, a little bit of that lower high and lower low pattern. So this is what it continues to validate. Support level is going to stay put at 2884. So this right here, very, very important level to keep in mind for Ether. And if we do end up, let's say, breaking down, next support is going to be inside this green rectangle, sitting roughly at $2,100 for Ethereum as well. Talking a little bit about the 10-year treasury. So yields are also now starting to rotate back lower, which is good news, which is good. And that's exactly what's causing the markets to somewhat push higher as well. TMF might also be recovering right now. So we're back from $42, $43 back in the $47 range. It's up another 10.5% from its lows. And TLT also recovering a little bit on the back of 10-year treasuries selling off. And, you know, that's exactly what we needed basically for the markets to push higher, because this, as the 10-year treasuries continue to push higher, they obviously put more pressure on equities on the stock market. So keep a close eye at these levels next. That's going to be sitting roughly at 4.3.5 to 4.3%. And of course, all the way up to inside this red rectangle, much stronger area of supply. And that would be a level where, you know, TMF is going to become very, very attractive from a tactical trade standpoint once again. So that's going to be sitting roughly at 5% for the 10-year treasuries. Now, coming back over to the markets here. So let's start with the S&P 500. So this was the 30-minute time frame that we were analyzing in our previous videos. You can see a very nice higher high and higher low. And then today, we got a reasonable breakout above 5,100. So this right here, a very nice breakout. We'll go ahead and turn this level into a support now for S&P. And the next target is going to basically be all the way up. Well, I guess there's a couple different levels to watch. So first one's going to be over here at 5188. Call it 5,200 to be precise. And then another one is going to be sitting right over here at 5218 all the way up to 5263, pretty much the all-time high. Now, the reason why there's so many resistance levels is basically because we're looking at the 30-minute time frame, so we're on a shorter time frame. That's why there are more resistance levels to watch. But of course, on the daily time frame, we'll pretty much be looking at the all-time high now at 5200. And that's where we have gotten rejected and haven't recovered since March 21st of this year. So lower highs and lower lows, huge downtrending channel, then a bigger breakdown over here. Then, of course, higher highs and higher lows again. So a little bit of a shift in the overall pattern. And next resistance and target, like I said, it's going to stay put at 5189 to 5200 to as much as 5220 for the S&P. NASDAQ, on the other hand, is already almost back up to all-time highs. So resistance is going to stay put roughly at 16,475 for the NASDAQ, and support level is going to stay put, of course, at 16,000 points on the NASDAQ. Triple top, quadruple top resistance here on the NASDAQ. So again, we'll find out whether it breaks out above this level to new all-time highs or if it gets rejected once again. But support level is going to stay put at 16,000 down to 15,900. And again, when the money invest index is lower, markets are lower, then that's going to be a buy signal. That's going to be buying opportunities for us once again. Coming over to Apple, and Apple here on the day, pulling back. So starting to fill a little bit of this gap to the downside. So this is the gap that we have talked about in our previous videos. Also validating that 200 simple moving average at the moment. And again, much stronger support sitting right over here in the 170s for Apple, all the way down at that tier 2 support in the 150s, down to as low as 120s, 130s for Apple as well. And of course, resistance is going to stay put roughly in the 190s. Apple, for me, at these prices is not a buying opportunity as of yet because of the premium valuation that it trades at relative to the growth rates. I do believe Apple is expensive at the moment. Amazon, on the other hand, also coming up to 188. That resistance that we talked about, it did see a bit of a pullback over here as the markets were seeing a dip. 12.5% correction on Amazon, recovered very nicely, a V-shaped recovery back up from that higher low. And right now we're kind of testing that resistance, and the all-time high for Amazon is pretty much here. I mean, if it cracks up a 190, if it gets up to $200, then we have achieved our $4,000 goal. 4K Fridays are going to be finally a reality if Amazon can get up to over $200 per share. So moving forward, talking a little bit about Tesla. So Tesla here also validating that support. So moving back up to 177 support, moving up to 184. But again, it's kind of, there's a huge resistance over here and a supply for Tesla. So support level is going to stay put at 177. And of course, we've got a massive area of resistance and supply over here for Tesla, as we've already discussed, and I will be looking at selling calls once again for Tesla the moment it gets up to over $200 per share. And of course, we got that 200 SMA sitting right over there at 219. So Tesla, I will be doing a more separate, more dedicated video on this company, so make sure that you do check that out. But the bottom line is, of course, it's got potential, but we do need to see some breakouts in order for us to see that trend reversal in a Tesla. NVIDIA, prior to earnings, very, very nice move to the upside. It looks like the momentum is once again back for NVIDIA, pushing higher. So huge resistance breakout above $909. And the next target and resistance pretty much at the all-time high at 971. We did see again the RSI, the MACD, the L3 banker oscillator, everything coming down after the correction on NVIDIA stock of 21%. And of course, lots of buyers stepping back in and pushing this stock price back higher, back in the 920s. And this right here, 22% rally here. And the next target resistance is going to be at 971 basically. Talking about advanced micro devices, and AMD also starting to break out above this. Again, RSI MACD was looking good when we discussed it. L3 banker oscillator also looks pretty solid, validating that 200 simple moving average. So we'll go ahead and turn this level back into a support for AMD, and that next target and resistance is going to be closer to 164, 165 for AMD here, all the way up to 183 for this company, right? So I do think that after this huge sell-off for advanced micro devices, there is potential for us to see some recovery back up to 164. We've been talking about this as a potential reversal trade, considering how oversold this stock was for some time. So that next target is going to be up to 164 for advanced micro devices. Talking about PayPal, and PayPal here on the day continues to consolidate sideways right above that support here of $65. So nothing crazy. Resistance and target's going to be at $68, $69. So that's inside this red rectangle over here. We're just not able to break out above this level for some time. And support level, like I said, it's going to stay put at $65, kind of aligned with this green rectangle over here as well. Visa, on the other hand, is also seeing a little bit of that momentum after being very oversold. So RSI, MACD, and of course the L3 banker oscillator selling off, and then resistance is going to stay put at $290 for Visa, and support level is going to stay put at $265 for Visa as well. So that right there, reasonable sell-off over here, down about 8%. And that next target and resistance is going to stay put at $290, and support level is going to stay put at $264 for Visa. Talking about Meta platforms, and Meta here continues to move higher beyond that resistance, starting to fill this entire gap. Lots of buyers stepping in, so that's good. But it's in that area of supply. It's inside this red rectangle, so we'll have to wait a couple more days to see whether it breaks out or if it gets rejected here. Everything lines up perfectly right now. So RSI looks good. MACD is almost crossing over that signal line. The L3 banker oscillator also starting to kind of round back up here. So things look good, and there is potential for us to see a breakout for Meta beyond 475. And that next target and resistance is going to stay put right over here, pretty much the all-time high in the 515 to 530 range for Meta platform. So that is going to be that next level to watch. Talking about Netflix, and Netflix here also moving higher. So it's almost now testing that resistance at the moment. So this right here is going to be that level to keep in mind, also aligned with that I believe that 50 moving average or the 200. So I believe that is the 50 moving average. So that is going to be that target and that resistance right now. Support level is going to stay roughly at 536 for Netflix. Google, on the other hand, of course, gapped up after the earnings, saw a little bit of a gap fill to the downside, and now recovering back higher. Still, in my opinion, trading at a bit of a overextended, overbought level. Support level is going to stay roughly in the 150s, down in the 130s for Google moving forward. And right now, Google is not at my buy target yet, and neither is Microsoft with a very nice recovery from this support level. So inside this green rectangle, we talked about how there's reasonable support and demand at those prices. So Microsoft, of course, pushing back higher, but the real question is whether it breaks out above this resistance or not of 417. So that is going to be that level to keep in mind, all the way up to as much as 430 for Microsoft as well. Support level kind of aligned with that 200 simple moving average, also in line with that $363 per share for Microsoft as well. And finally, we come over to Enphase and Costco. So Enphase here, I did a video on Enphase earlier, so make sure that you do check that out. So it's a little bit uncertain and more volatile than other stocks here. So lower highs and lower lows, kind of consolidating and validating that support here, all the way down to $92. That's going to be that next support if it, of course, breaks down. And we got a massive resistance to break out of in the 130s for Enphase. Gotten rejected there not once, but twice, and probably even 3 times if you consider this over here back in March 11th. And finally, we come over to Costco, and Costco here also recovering very nicely, so breaking out above its resistance of 747, and the next target and resistance is going to be all the way up over here at 785 for Costco, and this of course will turn into a new support for the company. So the bottom line is that markets are recovering well. NASDAQ's almost back up to all-time highs on the back of dropping treasury yields, on the back of expectations that, unemployment numbers came in a little bit softer. It did tick higher, so there's probability for more than one rate cut, and that's what the markets are pricing in once again. But again, it's really just going to be, I do strongly believe that inflation is going to be a much bigger catalyst for rate cuts than unemployment will be. And to kind of give you a little bit of perspective, a weaker inflation reading is going to be a much better catalyst, in my opinion, for rate cuts than a weaker unemployment number. So what that means is it just comes down to what is the Federal Reserve going to prioritize, right? Are they going to prioritize bringing inflation down, or are they going to prioritize making sure unemployment doesn't get higher and they've got a stable economy on their hands? I feel they're going to prefer and prioritize the former. They're going to make sure that inflation doesn't go out of control, and it is coming down to that target of 2%. Even if that happens at the expense of economic conditions weakening, even if that happens at the expense of unemployment going higher, that's just how Jerome Powell and the Federal Reserve thinks about the current dual mandate. They prefer and they prioritize inflation more than unemployment. So the market's pushing higher, or the fact that we're seeing more rate cut expectations on the back of weaker unemployment, I think that's a little bit of a stretch and a bit of an overreaction. I would much rather prefer for rate cut expectations to go up on the back of inflation coming down. I think that would be a much better, much stronger catalyst than of course, the economic conditions weakening, because it's it's kind of like catch-22. You've got markets optimistic about rate cuts, but at the end of the day, what are we really optimistic for? We're optimistic for unemployment going higher, economy entering a recession, economic weakness. That's not something to be optimistic about, right, from the market. So inflation coming down, in my opinion, would be a much better catalyst for markets repricing of more rate cuts. So hope that makes sense. But as always, make sure, let me know what you think about this. Make sure that you drop a like, subscribe to the channel. Links to our Discord and Patreon is going to be down below. Again, do connect with me on Instagram. My handle is going to be CastWRP. Join our Patreon. First week of the month is the best time to join with our entire 50 plus videos, including our 30 stock shopping list. And individual courses are going to be 50% off. Coupon code May50 expires at the end of this month. So always happy investing. I'll see you all in the next video.